Welcome to this Masterclass Explainer. Look, if you're a highly focused learner targeting that elusive A-star in IGCSE Accounting 0452, you are in exactly the right place. I'm your subject specialist, and today we're absolutely tearing down the complexities of one of the most conceptually demanding modules in the entire syllabus: interested parties and limitations.
And I'm the senior examiner. I'm here to bring you the high-level financial intelligence and the exact evaluation skills we are actively looking for when we're marking your papers. Because let's be honest, this isn't just about memorizing rules anymore. So grab your notebook, get focused, and let's elevate your exam strategy.
Okay, let's quickly run through our roadmap for today. 1. Core concepts in architecture. 2. The method mark strategy. 3. Evaluating financial health. 4. Modern fintech in real world. And finally, Section 5, Examiner Secrets and Strategy.
All right, let's dive right into Section 1, Core Concepts and Architecture, Building the Foundation. So first things first, Cambridge is fully transitioned to modern international terminology for the syllabus 2028 to 2030 updates. You absolutely must use terms like irrecoverable debts and owner's equity. Honestly, relying on the old terminology just won't cut it anymore. Exactly right. Think about the interested parties here. We're talking about banks deciding on commercial loans, owners analyzing their returns, and tax authorities auditing the records. They rely entirely on the absolute integrity of these specific documents. When you use the updated terminology, it proves to us that you have a fundamental grasp of the duality of every transaction and that you clearly understand the strict boundaries of the business entity concept. Now, listen closely because the magic number here is literally 100. We demand 100% accuracy when you apply this modern terminology to maintain the fundamental accounting equation. During any fiscal period, your assets must always equal your liabilities plus equity. There's no wiggle room there whatsoever. Your records have to perfectly reflect the historical cost principle, meaning assets are recorded at their original purchase price. That's what ensures absolute reliability for anyone auditing the firm's overall health.
Right. But simply recording those historical costs isn't the whole story, is it? You also have to vigorously apply the prudence concept. I like to think of prudence kind of like packing an umbrella on a perfectly sunny day, just in case. In accounting, it means you must never, ever overstate your profits by ignoring potential losses. For instance, if there's a strong chance a customer isn't going to pay their invoice, you have to account for that irrecoverable debt immediately. If you fail to do so, you're violating the prudence principle and, frankly, presenting a dangerously optimistic and inaccurate picture to all those interested parties.
Let's keep the momentum going with Section 2, the method mark strategy, procedural logic. Okay, this visible procedural flow is basically your advanced technical methodology for securing points, even if worst-case scenario, your final mathematical balance ends up being completely incorrect.
That's right. In the exam room, we literally award you method marks just for your process. Step 1 is identifying the correct source document, like an invoice or a credit note, to properly document your evidence. Step 2 is accurately recording that data into the books of prime entry. And Step 3, well, that's mastering the T-account structure, the absolute gold standard of the double entry system. You have to clearly show how you balance the account, deliberately distinguishing between your balance brought down and balance carried down. If we can visibly track your step-by-step logic, we can absolutely award you marks for it.
Of course, the ultimate goal is hitting that 100% mathematical accuracy in the trial balance phase. Because a perfect trial balance seamlessly feeds into those final financial statements. But getting there, well, that requires dodging some incredibly common mathematical pitfalls. One of the absolute biggest traps we see students fall into is miscalculating percentages when dealing with trade discounts versus cash discounts. Remember, trade discounts are deducted right at the invoice stage, before the number even enters the double entry system. Cash discounts happen much later, upon payment. Keeping those two procedures strictly separated is exactly how you maintain a flawless trial balance.
Moving on to Section 3, Evaluating Financial Health, the AO3 Edge.
Look, calculating a basic ratio is just a baseline skill. Investigating what that ratio actually means in the real world, that is where the A-star AO3 Edge is won. Imagine a business's current ratio falls dramatically from a very healthy 2.5 to 1 down to a risky 1.1 to 1. You have to debate the cause and effect chains. Has the business overpurchased a ton of inventory that's now just sitting there unsold? Are trade payables being settled way too slowly, which is damaging essential supply relationships? Or were cash reserves suddenly wiped out by a massive capital expenditure, like, say, buying a bunch of new machinery? Mapping out these complex, multi-step scenarios is what shows us true investigative skill. And this high-level evaluation absolutely applies when you're conducting inter-firm comparisons too. Comparing two completely different businesses is incredibly difficult because of differing accounting policies. Take depreciation. Firm A might use the straight-line method, spreading the cost evenly over an asset's life. Meanwhile, Firm B might use the reducing balance method, massively front-loading their depreciation expenses. So on paper, Firm A's profit looks way higher in those early years. But is it actually performing better? Or is it literally just an illusion created by their accounting policies? As an A-star student, it's your job to point out these specific limitations. Exactly. And to truly evaluate the quality of a profit, and to really analyze a metric like return on capital employed, you absolutely must look beyond the numbers. You have to integrate vital non-financial factors into your practical coursework. Think about it. What is the state of staff morale? I mean, a highly profitable company with a miserable, burnt-out workforce is heading straight for a crash. What about the business location, or its overall market reputation? These elements are completely invisible in a standard T account, yet they are strictly tied to long-term sustainability. Mentioning these in your AO3 answers proves to us that you truly understand the real-world limitations of financial records.
All right, Section 4, Modern FinTech in Real World, the 2025 Industry Application.
Okay, this is a vital industry application, pulled straight from the current research directive. Today, AI-driven accounting software, like Xero, handles the procedural flow effortlessly. It automates the T accounts, it balances the books, and it generates beautiful financial statements in milliseconds. But here is the critical part. Here is what AI cannot do. It cannot perform that high-level AO3 evaluation we just talked about. It cannot interpret the nuance of those non-financial factors or debate the long-term strategic impact of a suddenly depleted current ratio. The mechanical data entry? Yeah, that's completely automated now. But your sharp, critical, human mind is absolutely irreplaceable when it comes to analyzing interested parties and limitations.
And finally, Section 5, Examiner Secrets and Strategy, Securing the A-star. Listen closely, because this is a direct, urgent warning straight from our examiner insights. First off, poor handwriting in ledger accounts is a massive, totally avoidable point loser. If we cannot clearly read your balance brought down, we literally cannot award you the method mark. It's that simple. Second, students repeatedly fail to distinguish between revenue items, like everyday repairs, and capital items, like purchasing a brand new delivery van. Mixing these two up completely destroys your profit calculation and invalidates your entire balance sheet. Don't let that be you. So let's lock in those top marks right now with this rapid-fire A-star exam checklist. 1. Manage your time effectively according to the question weightage. Please do not spend 20 minutes on a basic 3-mark calculation. 2. Write legibly in all your T accounts. Help the examiner give you points. 3. Show absolutely all of your workings to capture every single method mark available, even if you start to panic at the very end. And 4. Systematically and accurately classify your revenue versus capital items before you write down a single number. When the clock is ticking down and that intense exam pressure hits, it is so easy for your mind to just go blank. So, here is a crucial memory hack to ensure the fundamental accounting equation is never ever forgotten. Remember the word ALOE, A-L-O-E. Assets equal liabilities plus owner's equity. Seriously, write this acronym at the top of your paper the absolute second the exam begins. Every single complex multi-step problem you face is ultimately going to tie right back to maintaining the balance of ALOE. It is your anchor in the storm of Paper 2.
Before we wrap up this explainer, we want to leave you with a provocative A-star challenge to really test those new skills. I want you to pause and think deeply about this. If a business incorrectly records a $5,000 capital expenditure, let's say they're buying some brand new equipment, as a revenue expense like general maintenance, exactly how does this specific error cascade through the accounts to impact the owner's equity? And furthermore, how does it interact with the prudence concept we discussed earlier? That's a great question. You need to work through that entire cause and effect chain. Master that specific scenario, and I promise you, you have mastered this entire module. Keep pushing your limits, stay focused on that A-star, and we'll see you in the next Masterclass Explainer.